Right. How do we hit remind me later? How do we do that? Is this a touch screen?
It is, yeah. What do we have there?
Oh, it was just
They're
an
ready to do
update.
your Windows update.
They want you to do an update.
Oh, no, not right now.
Right. So hey, remind me later. I don't know how long that will take. But.
So do you have water?
Yeah. Okay.
Oh, is it? I mean, which time are we using, I guess? What time do you have? Do you have 8:30?
It's like oh yeah, it's pretty much 8:30. A few minutes.
Oh, good morning. Okay, we're going to go ahead and get started. Apologies, our mayor couldn't be here this morning. My name is Becky Newton. I'm the Economic Development Manager here for the City of Lakewood and your host today. So if you need anything, please let me know. A couple of housekeeping items. There's lots of food. Please help yourself. Coffee and bagels. If you're looking for the restroom, if you go back out the doors and to your left into the main area of City Hall, to your right is the women's bathroom, and just past the reception is the men's. And we hope you enjoy the seminar and learn a lot today. Welcome to Lakewood. We're glad you're here. And hopefully you'll stick around and do some shopping here in Lakewood if you have time. And at this time, I'd like to introduce Hans Kuick, who will move you forward with the program. Thank you very much.
Hi, thank you. And Hans Kuick with Pierce County Economic Development Department. And we try to put on these educational events as topics percolate up. And I was just saying this isn't as sexy a topic as marijuana in the workplace, but you know, I think it's something that has become necessary. So I'd like to start off by introducing the Pierce County Executive, Bruce Dameyer, and he'd like to say a few words.
Thank you, Hans. Thank you, Becky, for hosting. So I was kind of just doing the rough math. I think if we were in Seattle, there's about $12,500 worth of head tax in the room, right? And I think that's a great illustration, frankly, of the difference, right? They're trying to figure out crazy things to raise money when they're already spending a crazy amount of money on homelessness and other things. This is the exact opposite. This is how we're trying to help you. One of many things we're trying to do to help you understand the recent federal legislation and how you can take advantage of that to invest and do more and ideally hire more employees. We don't want to punish you for having employees. We want to incent you to have good folks who can have good jobs here in Pierce County. Some of the things that we're also doing here, and I'd also like to introduce a couple of folks from Pierce County. We have Kevin Clegg, who heads up our Economic Development Office right now, and Catherine Rudolph, who works up on my floor with me directly. That's how important we think economic development is and getting good family wage jobs here in Pierce County. So Catherine works directly with me up there, and Kevin has the office and works kind of coordinating. A couple of other things that we are doing. You know, this is about, when I talk to people, economic development is kind of my number one priority. I think if we can continue to grow, you know, as you all know, that Seattle and King County has been, economic development's been like that, our economy's been growing like that, and ours has been growing modestly, and now we're suffering from some of the impacts from their superheated economy, right? Housing in particular. Well, that is not healthy for us long term. We want to have good family wage jobs here. We want to have that. That'll bring about the kind of quality of life that we all want for our families and for our neighbors and for our communities, right? We want a robust communities where people can live, work, and raise a family. So that speaks to that whole quality of life piece. Some of the things that we have done and are doing, one is we're working very hard to streamline and simplify permitting at the county. That's a continual focus and priority. We've done some consolidation out there to bring kind of sewer used to be in a separate permitting stream. Now that's all under one. We're continuing to try to do that with the health department, with septic and water as well. So we're continuing to work hard there. We have a red tape reduction task force which is one that focuses on bringing industry in working with our staff to look at streamlining regulations. They just went through development regulations. Their current assignment is to take the nearly 105 commercial zones in unincorporated Pierce County and reduce it to 5. So it's an example of what we're trying to do to bring investment in Pierce County. The last thing that I would mention, one of the things we're also working on is looking at how when somebody is starting up a new business here in Pierce County, as a small business owner myself, I'm a printer and we have a printing company just right down the street here. So I understand that when you're starting a new business or looking at expanding, that's when money, cash is king, right? Money is at its most precious is when you're trying to get new things started. So one of the things that we're trying to do, and particularly looking at our sewer connection fees, which had evolved to a big, significant dollar amount right at the point of initiating a new project. And we're looking at saying, no, how can we change that? How can we spread that out over time when you've got more ability to deal with those expenses? So I hope I am setting the tone like Hans and Kevin and Catherine are doing and Becky are doing, that we value what you do in our county and we want to encourage you to do more of it. So anything we can do, if you've got other ideas for education aspects, please make sure Hans knows about it. If you've got great ideas for policy changes that you think would help us grow our economy and grow jobs here in Pierce County, we are all ears. So thank you very much for coming out this morning. I appreciate it and appreciate the City of Lakewood stepping up. Thank you. Thanks, Hans.
Thank you very much. Great. So I think we'll just move right into the program, and we're still expecting people to kind of filter in. So I think the way, if I'm correct, we'll have a presentation, and then there'll be time for a Q&A toward the end. So you want to be able to write down your questions. But let me introduce first the two ladies that will run this. And Anita Eichenberger is a managing shareholder, and she has 26 years management and industry experience, 14 of them in accounting, a member of the American Institute of Certified Public Accountants, Washington Society of Certified Public Accountants, and she has a Bachelor's of Arts degree from Business Administration from the University of Washington. And her focus is closely held businesses, and she advises on corporate and individual tax matters. And that's Anita right there. And Holly is Cooper, which I think is really kind of interesting. And so Holly she has 14 years of professional experience, also a member of the American Institute of Certified Public Accountants, and a Master of Accounting degree in tax concentration and a Bachelor of Arts in Business Administration from WSU. And her focus is manufacturing, real estate construction, and multi-state tax for businesses and individuals. And in her off time, she's a board member on the, are you still, of the Job Carr cabin, which I didn't even know there was one until I saw this and then looked it up. How many people have been to the Job, is it Job or Job?
Carr Cabin Museum, first settlers of Tacoma.
This is a plug for now. It has now turned into a plug.
Yeah.
But I'd like to turn it over. Are you going to use that microphone?
Yeah, we're going to try this mic, and then I'm a pretty loud talker, so you guys can tell me if you can't hear me. But thank you very much, Hans. Thank you for inviting us to come this morning and talk about mine and Holly's favorite topic, which is tax. I'm sure you guys are excited about that too. This is a big law change, and we couldn't cover the whole thing in an hour and a half or 2 hours. And so we've picked a few areas that we think is most important for people to start thinking about and understanding. And we're going to be covering the business tax rate changes, some tax benefits, and some things that are expiring that maybe you aren't aware of. We're going to talk about individuals some, and then we're going to end it with some business tax saving incentives. That some are new, some are just remaining, but ones that will still work and still worth looking into. Okay, so to kind of set the stage, so this was a huge legislative change. It's the largest tax act in over 30 years. You guys probably all have heard about and read about the 21% tax rate for corporations. If you were paying at the highest rate and you were at 35%, this is a really big change. But that doesn't, a lot of our small businesses, and probably many of you are not C Corps, many of you are probably LLCs or S Corps or partnerships. And there were also changes for you that happened to try and even the score, so it wasn't just C Corps getting all the benefit. Again, there's significant individual changes, and I guess I would want to tell you that it's not all figured out yet. So we're going to address a lot of these things, but when the legislation came out, the IRS hasn't weighed in yet. They said they're going to start giving us guidance in June, but probably as we were learning changes, as many questions came up. So we're going to share with you some of the big questions that are coming up, and we would expect to start getting some answers and be able to start forming our strategies this June. We're not going to cover the state tax considerations a lot, and we all know we don't have a state income tax here in Washington, but I'm sure many of you file tax returns in other states, very common now, and you should just be aware and talking with your CPA, because it's not likely that the states are going to follow all these tax changes that came on the federal level. So it's just going to make the state tax returns more complicated, and as states will probably do different things. They might do part of it, but not. So again, you want to be talking to your CPA about how this new tax law change is going to affect all the states that you might be filing taxes in. Okay, so we'll start with the corporations. It's kind of more straightforward. So we now have a flat 21% tax rate for corporations. So it's not a tier that we're all used to. So if you make $6, you pay 21%. If you make $600,000, 21%. That's pretty straightforward. So this is what the new corporate tax rate looks like. And when I talk to clients, a lot of times what they don't realize, if you're a C Corp, we don't always just think about what the tax is for the corporation itself. At some point, you're taking those profits out of the company, the shareholders are. And so we really look at what's a combined corporate individual rate. So this shows the marginal rates there are the new individual rates, depending on what taxable income you're at, and the corporate rate. And then if you pay 21% tax on that income, now you have 79% left to distribute out on your, for your dividends. So this is what the combined rate looks like now, and we'll talk about it later, but the top rate used to be a little over 50%. So that's the savings we see. We've also, I was going to mention, we did give you guys handouts, and I know this is kind of heavy material. So if you want to jot down questions you have, we will be doing questions at the end, and also has all this material in there, all these slides. Okay, so this is probably one of the most confusing and complicated part of the new law. And when the corporate rate lowered, the legislation was trying to figure out what would they do for all the other small businesses, the pass-throughs. So this is what they came up with, and this is Section 199A, and there was already a Section 199A, and Holly will be covering that later, what happened to that. But the simplest form of this, the idea is to give S Corps, partnerships, sole proprietors a 20% deduction on their business income, on the simplest form. But of course, it can't be that simple. So there are limits, and there are certain businesses who are limited depending on what your business is. So as I just said, the deduction is available for trade or business income taxable on 1040s. So this deduction is not at the business level, it's at the individual level. So it would be on your 1040. So it doesn't matter whether you're getting that business income from a K-1, through a partnership, and even real estate. REITs are also going to be qualified for this potential deduction. Could be your Schedule C business, it could be a rental you have on a Schedule E, or it could be a farming schedule. All could potentially qualify. Another thing that is unusual, like normally we don't see business deductions on the individual side for passive activities. Passive activities are rentals normally, it could be commercial buildings or something like that. But they will be allowed potentially under this new rule. Okay, so the first concept we have to understand about this is what is qualified business income? So I think it's easier to think about like what is not included. So if you would start with your income statement, what is your profit or loss, you would start there. And I'm going to skip to the next slide and then we'll come back. I think talks. So what isn't in qualifying income is capital gains or losses. So if you have capital gains or losses in your business income, you'd have to take that out. Dividends other than ones that come from the REIT, dividends. Interest other than trade or business interest. So if you're getting a bank loan or something from a financial institution, you would still be able to include that. If you're investing in commodities, you wouldn't be able to do that. If you're participating in non-hedging currency transactions, you wouldn't be able to include that, and annuity income. All right. There's also a note there. So the difference of, I'm trying not to be too technical, but the 1231 gains are like gains that you pay ordinary income on. If you were to have those flowing through your business, it appears that those would also not qualify. Okay, so once we figure out what is our qualified business income, then we have to consider these limitations. So the limitations are, we hit a threshold amount, and if we go over the threshold amount, then we can only deduct, then it might not be 20% anymore. We have to do a calculation, and we have two possible calculations, and we take whichever one is higher. So the first calculation is we would take 50% of what the W-2 wages are that we pay to our employees. So that's pretty straightforward. Alternatively, we could take 25% of those W-2 wages and add 2.5% of any depreciable property we have in our business. So if we're a manufacturer, construction company, we might have quite a lot of depreciable property. And so that could get us a bigger number. I don't want to get too much into the weeds about what qualified property is in there, but it's basically anything that's being actively depreciated. Like sometimes we buy equipment, though, that's only like 3-year property or depreciates pretty fast. And so there is a minimum there that we can include those for 10 years, even though they're fully depreciated. So if they have a shorter life than 10 years, we can still include it in that calculation, but only for 10 years. Everything else, as soon as we're done depreciating it, we can't include it in that calculation anymore. Okay. Okay, so the thresholds are for unmarried taxpayers and married separate, $157,500. So the thing to note about this is not business income, this is your taxable income as a whole. So once I maybe have other forms, or maybe my spouse has other forms of income. So if on my individual tax return, if my taxable income is more than $157,000, then I have to apply these exclusions or these threshold limitations to my business income portion. And I'm going to go through some examples because I know this is complicated, so we'll get through it. If I'm a joint filer, then that number is $315,000. So the other thing to note about this, and I'm going to go back a couple slides, is there were specific kinds of companies that were eliminated from being able to participate in the higher amounts of this deduction, and those are what they're calling service companies. Now, this is one of the areas that there's a lot of questions because they haven't really defined, except for they definitely aren't going to allow accountants. I don't know why they're picking on us, but there will be no accountants, and they did make an exception for architects and engineers would not be considered service businesses. So if you are in one of these businesses that are considered or going to be considered a specified service business, then you only get the deduction if you stay underneath the threshold. So there's a phase-out period, which is $50,000 after the threshold. But after that, you would phase out, and there would be no deduction for you at all after that. So let's go through some examples, because I think that might, and I promise this is as hard as it gets. It's the most confusing. Oh, I wanted to mention, too, in the original bills, they weren't going to allow trusts or estates to take the deduction, only individuals. And so in the final bill, those were allowed. So you probably won't see that as often, but they did make it through. Oh, and I wanted to mention one more thing before we get into the examples. This has always been the rule, but they are focusing more attention on it now because I guess there would be some, if you're trying to maybe get more of your income into this qualified business income, so you could take the 20% deduction, you might be thinking about like, well, maybe I could lower my compensation. I'm owner of this business, and I'll just lower my compensation. I can get a bigger. And so we're going to warn you to be very careful about that because there's always been that you're supposed to take reasonable compensation. And you've probably talked to your accountant about that because quite often it comes up. If you're an S Corp, people tend to want to take lower compensation because they want to take out the distributions. And if you're a C Corp, you want to take larger compensation because you don't want to pay the double taxation of the dividends, take the money out. So they have enhanced the penalties here, and the same rules apply that you need to be taking a reasonable compensation for the job you do at your businesses. So again, we maybe will see some more guidance from the IRS on that in June. They haven't said exactly, and there's not a bright line of like what that is. So I would just tell you that you would want to make sure you're making considerations that whatever compensation you're paying yourself, that it is a fair market value, reasonable compensation. Okay. So here's the first, most simple application of this rule. So Steve is a married business owner, and he has a Schedule C business, and he has business income of $100,000. And we're going to just assume that that's all qualified, that there's no adjustments he has to make to that. He fills out his tax return. He's got some other interests and dividends and other things. So he's got taxable income of $150,000. So Steve is underneath the threshold for a single filer. So he gets to take the entire 20% deduction. He takes his business income, does a calculation of 20%. He lowers his taxable income by $20,000. So that's great. He gets a deduction for $20,000. Okay, so now the same taxpayer, he has some big deductions he takes on his Schedule A. So at the end of the day, he only has taxable income of $76,000 instead of $150,000. So there is a limitation. He can't take the whole 20%, the whole $20,000, because his business income is larger than what his net taxable income is. So in this case, he's limited to 20% of his taxable income. In this case, he gets $15,200. Okay. So now it's getting a little bit more complicated. So Adam is a married taxpayer, and he has business income of $200,000, but he has a lot more income sources. And he's married, and so his spouse works, and together they have taxable income of $750,000. So Adam does not have a service business, so he doesn't have to worry about that limitation. But he has to now do the calculation and decide which of the limitations is going to be better for him, the 50% wages or the 25% wages. So he pays $50,000 of wages in his business, and so 50% of that would be $25,000 limitation. And he also has $50,000 when he considers 25% wages and 2.5% of the basis of all his depreciable. So 25% of that is $1,250. Okay. So 20% of his $200,000 is $40,000. So there are the three possible deductions he can take. And in this case, his deduction is $25,000 because he's limited for the full deduction, but the higher of his two options is the 50% wages. Clear as mud, right? Okay. So here is the service provider. So Adam is a single lawyer, and Adam has business income of $150,000, but his taxable income is $195,000. So Adam is over the threshold, but he's not completely phased out because he has $50,000 coming up over the threshold. So this is what it looks like for Adam. So he has taxable income of $195,000 and the threshold is $157,500. So he's $37,500 over the threshold. But the total phase out is $50,000, so he still gets some. So $37,500 is 75% of $50,000, and so he has a remaining 25% that he can take a deduction for. His business income is $150,000. If he could get the full deduction, it would be $30,000. So he gets to take 25% of the $30,000, and his limited deduction is $7,500. Now, if Adam would have had another $10,000 or $15,000 of income, he would get no deduction. Because for the service provider, when he gets over the limit, there's no deduction for you. You're just completely phased out. Okay. So as I said before, there's just so many questions because we've seen the law, but there's really no guidance yet. So there's so many questions about how in certain circumstances will this play out. So some of the things are, as I've demonstrated to you, is obviously a business by business determination. So some businesses will get large deductions, some will get none, depending on if they're heavy in wages, if they're, how profitable are they? Will services taint otherwise qualifying businesses? I have a slide for that later. How will, if you have many tiers of businesses, how will all these thresholds play out? Will you have to, if you have related party companies, you know, we've seen that in tax law before where you have to add them all together to meet thresholds. So none of that's been addressed. And a question we've been getting ever since January is like, should I be restructuring? And so I would say that is still a question because so much of this isn't worked out yet. We don't know whether that would be a good thing to do yet or not. So this is sort of an example of what we're saying when the questions, many businesses have several service lines. So maybe 20% of my company is a service-driven company and 80% does manufacturing or something else. So will that taint the whole company or will there be some kind of allocation? We just don't know what the answers to that is yet. So kind of on that same line, a lot of clients are asking us, are C-Corps now preferred? Are they the preferred form of businesses? So sort of a history on that. S corps and partnerships have actually been preferred business for the small business owner, for the closely held business owner, for quite a few years now, since about 1993, and they became on the scene in like the 1980s. So has this new rule changed that, or do these new tax rules change that? So why were C corps not very popular in the old? And really the main reason was the double taxation that we talked about before. So if you're a C corp, the C corp pays tax, and then when I pay out the dividend to my shareholders, they pay another tax. So when you're flow through, like probably the structure many of you are, you know you don't pay that double taxation. You only pay once. So this slide shows the rate comparisons of the prior law and to what we now currently have. So that's been greatly improved. But as you can see, it is not better than the flow through just taken on a rate by rate. And sort of what the 20% deduction does is kind of keep the same kind of benefits, just not quite as big of a benefit of being the flow through. We're not going to go on that. I also wanted to remind people, so like some clients have been telling me, well, maybe I'll just switch to a C corp, but I'll just leave all the money in there, only pay 21%. If I never take it out, then I won't have to pay the double taxation. Well, I just want to remind everybody that this isn't a new rule, this is a rule that's always been on the books, that there is a tax if you accumulate a bunch of earnings in your C corp for no business reason. You can't just keep wealth in there to avoid paying the tax of paying out the dividends. There has to be a business reason why you're doing that. So if you're not reinvesting, you could get, this isn't a self-imposed tax, so you know, if you were to get an audit or get reviewed on your tax return, you could get imposed this extra 20% tax on top of all the other taxes. So that would be a pretty heavy incentive not to do that. So remember that doesn't play into that strategy. So what are some of the reasons that you might consider about whether I should be a C corp or whether I would be a pass-through? So one, on the side of the C corps, if you have a lot of NOL carry-forwards, if you convert to an S corp, you lose all your NOL carry-forwards. So you don't get to bring that with you. So you wouldn't want to make a conversion if you have those to take advantage of. Profitability, so that's really all about just comparing that rate. You know, what would be better for you versus a C corp or a pass-through. If you have a lot of profits and you're distributing them out, it probably is better to still be an S corp or something like that. If you're expecting continuous growth, then maybe it is better to be a C corp because you're not going to be paying out those dividends. You're going to be reinvesting them in your company. And if you have a long-term strategy of doing that, well, then the 21% tax rate is probably better for you. If you have a long time horizon before a sale or a shareholder's need for cash, it's sort of the same reason as before. And if you qualify for Section 1202 stock, so 1202 stock is a small business stock where when you sell it, you can have a portion of it, not have to pay capital gains. And you have to be a C corp to get that. And so that's sort of a common thing. You decide that when you start your company, you write it into your agreement or into your operating agreement. So you can't have 1202 stock in anything but a C corp. So that would be an advantage to doing that. So if you're an S corp or pass-through, a lot of people when they sell small businesses, they do what are called asset sales and not sales of stock. And if you do asset sales, there's an advantage to being an S corp because of the double taxation. So again, you'll get hit on a C corp side with that double taxation if you do an asset sale, versus if you sell stock, it's not as big of a difference. But most sales we see are some version of an asset sale. If you, again, want to withdraw cash currently, it's better to be the S corp. You don't get the 20% deduction unless you're a pass-through that we just talked about. You don't have the factors for being a C corp. So there's some, S corps can only have 100 shareholders. It's not a very good business structure if you're doing a lot of bringing in talented people, doing a lot of stock options, and it's more complicated. It doesn't always work out so good to do that. And again, you just don't have really anything to use the accumulated earnings for. It would be better to be S corp because you're just going to have to distribute them out of the C corp anyways. Okay, I'm going to, did you guys want to break and have some questions on that before we go on, or you want to wait till the end? Okay. If you're going to buy a building, normally people put that in LLC and have it in like a partnership. And if you own the whole thing yourself, if it's just a one owner, then the most simplest thing, you can still put it in LLC, but you can just do it on a Schedule E. In your 1040, you still qualify for all of the possible local deductions. So you wouldn't have to do a separate tax return unless you have multiple owners outside of like a husband and wife. Oh.
So would that,
So we don't know yet. So we don't know clearly what is going to be these service companies. So that is a big question. And we expect that this will be the first thing they start addressing when they come out in June. The IRS has said they're going to start addressing some of these things. So I would keep your eye on the ball.
okay, thank you. Can you hear me? We're a repair company, so it's all service. Yeah.
Okay, so we're gonna now talk about some tax benefits, some new tax benefits, some benefits that have been around, but maybe limits have been extended, and expired tax provisions for businesses. Okay, so probably the biggest thing that applies to all businesses is depreciation. And so what the legislature did this time around is they made bonus depreciation 100% deductible. So this has been, we've always had bonus depreciation the last few years, but there's always been limits on it. So one of those limits has always been, it had to be a new asset you purchased. So you can never take bonus depreciation on something that was used. So that was one of the limitations. They did away with that. So now, going forward, pretty much any tangible property you purchase to use in your business that you would capitalize, you now get to 100% write that off the first year when you place it in service. You still have to capitalize it, but you're just writing it off like you would 179 expense or bonus under the old rules. So that's one of the big benefits that came into place. Actually, that one started in September of 17, so it was a weird date. They did a pre-enactment where they went back and said September 28th of 17, this came into place. So on last year's tax return would have been the first year you got to take advantage of this additional first year 100% bonus deduction on used property. So the other thing that increased is passenger auto depreciation caps. So these almost tripled and increased. I feel like I skipped a slide. Let me see. Maybe I didn't. You're okay? Okay, so first year caps went from $11,160, that was under the old rules. Now they've increased to $18,000. Second year, the old caps were $5,160, so now it's up to $16,000. And then third year was $3,050, now it's up to $9,600. And then each succeeding year went from $1,875 down to $5,760 until it's fully depreciated. So these are caps on passenger autos, so it's not the caps on trucks and vans and SUVs that are $6,000 GVW or more. Those still do not have caps on them. So these are just the passenger auto caps that were under the old rules. So the next thing that happened was we had this definition of qualified leasehold improvements, qualified restaurant property, and qualified retail improvement property. Well, that was all repealed. So now that's not even a definition of property in the tax world. So that was old rules. So now they came up and they're just calling, basically they're combining all of that now and calling it qualified improvement property, which has different rules from the old rules under the qualified leasehold improvement property, restaurant property, and retail property. So the new rules say qualified improvement property is any improvement to an interior portion of a non-residential real property, except for if you're doing enlargements to the building, escalators or elevators, or doing an internal structural framework of the building. So if you're doing anything else to interior part of a building for non-residential building, that is depreciated over 15 years. So, which is similar to the rules of the qualified leasehold improvements. Those were also 15 years, but those had more stringent, more stringent rules where you couldn't use 15 years if it was a related party lease. Then you were kicked back to doing 39 years depreciation versus 15. And one of the other rules under that old law was the building had to be placed in service at least 3 years before you got to take that 15-year depreciable life. So that, again, is no longer in play for these new rules under qualified improvement property. So this is a benefit to taxpayers. And then the only other change they did was with bonus depreciation. You cannot take bonus depreciation now on any qualified improvement property, where in the past you could possibly take bonus depreciation. And then the big thing that happened with this was they extended Section 179 for roofs, heating and cooling systems, security and fire systems, which is huge because this has never happened before, where if you roofs, like all of these building systems were always capitalized and depreciated over 39 years. And so now they're specifically saying these specific items, you can take 179, 100% expensing up to your business income. So you still have to keep in mind, you can't take 179 unless you have business income. The other thing they're talking about is with the new capitalization and repair and maintenance rules that came out a couple of years ago, that had a lot of stuff in there to do with roofs. And so depending on what you're doing with your roof, you could have been expensing that roof under the repair and maintenance regs if you weren't taking the roof totally down, off the building, down to its studs. Under those regs, it said you could expense the roof as well. But now they're saying that's sort of a moot point because now it doesn't matter really what you're doing, if you're just replacing the shingles or if you're just replacing the membrane, you can just expense that roof. And there's no limit on that, so it's not like they're saying you only can expense up to $30,000 of a roof. It doesn't matter what the cost is. You can just expense that going forward. And then one thing I do want to backtrack with bonus. It's the same rules. You can take bonus depreciation even if you don't have business income. So really, you can take 100% expensing, bonus depreciation, and you can use that and have a loss for your business that year. So it's not like 179 where 179 is capped at business income. Bonus depreciation is not capped at business income. So that could generate a not operating loss for your company. Okay, so Section 179. So they did increase the maximum 179 expense to $1 million. And then the phase-out threshold is $2.5 million of new assets for the taxable year. So they increased this, but you also have, when you couple it with the bonus depreciation, it's sort of a moot point. But what guidance hasn't come out with and what they haven't changed is the ordering rules. So the ordering rules say, first you have to take 179 up to business income, and then you can switch and go over and use your bonus depreciation. So a lot of people are sort of skipping over this when this first came out. We're going, well, then why even take 179 when it's 100% bonus deduction anyways? But they haven't changed anything, so we still have those ordering rules that we have to apply and do 179 first up to business, and then we could take bonus for whatever's left that we didn't take under 179. And then I guess I would say the other thing is we still have 179 recapture. So if you dispose of an asset that has 179 on it before its useful life is out, you do have to recapture part of that 179 when you go and dispose or sell that asset. So that is still in place with 179. Okay. I guess the only other thing I would say with depreciation is just to keep in mind too the placed in service date, because I do have a lot of clients that a lot of businesses wait to year end, wait to November, December, and then they see where they're at, they do their tax planning, and they're like, oh wow, I have a lot of income and I want to get my taxes down. So the first thing they think of is, oh, I need to buy a new truck, or I need 5 new trucks, or I need a new piece of manufacturing equipment, right? Because they want that 100% expensing to get their taxable income down. So I would just keep in mind that the date placed in service is really important, and you still have to have those items placed in service, ready to go before January 1 of the next year to take the expense. Okay, so there's also a change in like-kind exchanges. So prior to this, if you did a like-kind exchange with tangible property, so I had a lot of clients that were constantly doing that with autos and vehicles, where they were trading in one vehicle, getting a new vehicle. And so those were like-kind exchanges, and you would defer the loss or gain into the new cost basis of the new asset and depreciate it. So now there is no more like-kind exchanges for tangible property. Like-kind exchanges only apply to real property. So going forward, you now are going to just recognize the gain or loss on that traded-in vehicle, and you're going to start depreciating that new vehicle or whatever equipment at the cost of the actual of what you paid. So that could trigger a book-to-tax difference. So depending on if you're doing book financial statements or GAAP statements, and they are doing the trade in intangible property and deferring the gain or loss still, for tax purposes, you can't do that anymore. So that would cause a book-to-tax difference for you. Okay, so entertainment expenses. This was sort of a big one where there is still a lot of unknowns. There's still, I'm going to go over some examples for you because I feel like a lot of people have questions surrounding all this entertainment expenses not being deductible. But basically deductions for business entertainment and membership dues were eliminated. So, and I'll go over some examples here in a minute. Employee achievement awards may not be deducted anymore or excluded from employees' income if it's paid in cash, gift cards, meals, lodging tickets, or similar items. So if you don't include it on the employee's W-2, you cannot deduct it. And then employee providing any facilities will be subject to the 50% deduction, whereas before you got to take that 100% deduction. So if you still want to deduct entertainment costs for employees, the only way to do that is to include it on their W-2. So if you include on the W-2, you can still take a business deduction for it. Okay, so I just wanted to go over a couple examples of what would or wouldn't be deductible for entertainment expenses. So for example, costs of taking clients golfing or to a ball game, those would be non-deductible going forward, starting 1/1/18. So if it's a package deal where you're buying a ticket to a charitable sporting event, that's actually considered non-deductible, but then any charitable portion that you donate, that portion would still be deductible. Cost of dinner with a customer or client prior to or after entertainment, that we're expecting further guidance on, depending on the situation, depending on what you're doing, it could or could not be deductible. Cost of snacks and refreshments purchased during sporting events. So normally you would think that would fall under meals, but they're saying no, it's related to the entertainment. And so then that would also be non-deductible. Cost of occasional holiday parties and picnics for all employees. There is no change to that. So those are still 100% deductible costs. Cost of meals incurred by employees for business luncheons or traveling on company business. So there's no change to that. Those are still subject to the 50% limitation, as long as they're not extravagant or lavish. And the cost of meals incurred by employees while attending a meeting at like a Rotary or a service club. The meal deduction would be subject to 50% limitation, but the cost of dues for memberships in service clubs are non-deductible, but the expenses relating to attendance, like at chamber meetings, stuff like that, those are deductible. So again, we're expecting further guidance on these things because there's a lot of combination of things that going on here between entertainment and meals. So I would just say, you know, again, talk to your CPA, but there's a lot of people now that are changing their books, or before you just had one GL account where you were booking meals and entertainment because they're both subject to 50%. Well, going forward, you're gonna have to add a new GL account and keep track of which ones are the 50% and which ones are non-deductible entertainment. So that's something to keep in mind, that you wanna look at your accounting GL and make those changes to going forward. Okay, so another thing that changed with employee benefits is the qualified transportation fringe benefits for van pools, transit passes, parking, and bicycle commuting benefits. Those are now disallowed deductions. So again, you can't, before those were not included on employees' W-2s, and the business got to deduct them. Well, now they're no longer deductible, unless you decide you want to start including those on W-2s. So that would be the only way you get to deduct it. And tax-free reimbursements of employment-related moving expenses is suspended. So it's the same rule where before those weren't taxed to employees, you got to deduct it, the moving expenses, well, that's no longer the case. So either you're gonna have to include on W-2s, deduct it, or you're gonna not include on the W-2, but you're not gonna be able to deduct it on the business side. Okay, so another change, so this inventory in section 263, small entity exclusion came out. Okay, so this isn't gonna apply to everyone sitting in this room, but it will apply to any producers, any resellers that were doing 263 inventory. You had to, basically what 263 is saying, you have to take your indirect costs and overhead of employee and other costs, and you have to capitalize part of that into your ending inventory till you sell it. And it's just a timing difference. So all producers have to do this, and some resellers have to do this, and distributors. This came out and said, now there's a small business exclusion, so these rules don't apply anymore to businesses with gross receipts under $25 million. So if you were doing this 263 capitalization inventory, which is just a tax thing, so you wouldn't be doing it for book purposes, it would just be on your tax return. You no longer have to do this, but it is considered a change in accounting method, and so you will have to file an additional form 3115 with your tax return next year to change your method back so you're not doing 263A. So if you are doing that, I would just talk to your CPA, and if you have questions about how they're handling that last timing adjustment for your tax return, they can let you know how they're going to do that for you. Okay, so they also put a limit on business interest. So this is big for bigger companies. So this does not apply to smaller businesses as well. So this is another cap. If you do not exceed $25 million of gross revenues, this business interest limitation does not apply to you. So you don't even have to worry about it. But if you are over that threshold, then business interest is limited to the sum of your business interest income and 30% of your adjustable taxable income of the taxpayer for the taxable year. And then there are some exclusion items, so you don't take into account interest and operating losses, some depreciation, depletion items, and then the new flow-through deduction is also ignored for that limitation. So AMT, corporate AMT was repealed. So I think there were a few corporations in here. I don't know if you were paying AMT before, but you're still filing the AMT schedule. So AMT is now repealed, and there is no AMT at the corporate level going forward. The cash method has also been expanded. So before, if you're a business doing $10 million of gross receipts, you could do the cash method. And if you were over that, then you couldn't use the cash method anymore. So now they expanded that up to the $25 million as well. So now if you're a business, you can still stay on the cash basis method up to $25 million of gross revenues. So DPAT, so this is the old Section 199 deduction, which is the domestic production activity deduction, which applied to businesses that produced something, that made something, that extracted something on U.S. grounds. They got this Section 199 deduction, and it was limited. You got to take 9% of whatever your domestic production activity income was, but it was always limited to taxable income, is always limited to 50% of wages. So for a lot of companies, this is a really big deduction. And now this is just, it's gone. It's completely gone. And so we don't have that anymore. So they took that benefit away from companies. But they gave, like Anita just was going over earlier, they lowered the C Corp rates, and they have the new pass-through deduction to sort of help offset this deduction that they took away from taxpayers. Okay, so then there are quite a few energy efficient provisions that have expired. There were some that actually expired in December 31st of 2017, like the 179D and the alternate fuel credit. And then they came in, I think it was like towards the end of February, and they retroactive it and then said, you can take it now through December 31st of 17. But as of today, these credits are all expired. So if you are taking any of these, the 179D energy efficient commercial building deduction, the alternate fuel, so if you have any equipment, or if you're a lot of construction companies get a big credit for the alternative fuel, solar, lighting, energy, heat, those, as of now, are all expired. Okay, so loss rules, what they did with that is they put new limits on how much losses a taxpayer can take at the individual level. So if you're a flow-through entity owner and you get a K1, you always had these loss limitations. There were three tiers. So first you had your basis limitation, And then you have your at-risk limitation. And then you looked at if the activity was passive to you or not. And if it was, then you had another passive loss limitation. So what they did now is they added a fourth tier limitation onto taxpayer losses, and they're calling it the active loss limitation. So before, if you're an active business owner and your loss flowed through, it didn't matter how much loss flowed through to you, as long as you had basis in your company and there are active losses, you had no caps on the amount you could take. Well, now you have a cap. And for manufacturing joint, it's $500,000. And for single, it's $250,000. And again, this is on the taxpayer level because it's for flow-through entities and not at the business level. And the losses can only be carried forward, not back anymore. So this could be a big change for a lot of people. I know some years, some businesses have big losses, some years they make a lot of income. So I would just keep in mind, like if you're manufacturing joint and have over 500,000 losses that you're thinking you're gonna take on next year's tax return, you need to rethink that because you're not gonna get the whole $500,000, or you're not gonna get the amount above $500,000. And so with that loss limitation, they also put these limitations and change the now operating loss carryback rules. So going forward, you can no longer carry back now operating losses. Under old law, you could carry those back 2 years and forward 20. So now there's no NOL carrybacks, but you can carry forward indefinitely. So that's a change that was made. And the other change that was made is they're only allowing you to deduct 80% of a net operating loss the current year. So you sort of have a couple limitations to these losses. Now you have the active loss rules that limit $500,000. And then you also have this 80% NOL cap NOL deduction that they're saying you can get. So for instance, if you had $200,000 in operating loss you're carrying forward to next year because you didn't get to use it all the year that it arose, next year you're not going to be able to take the $200,000 net operating loss either. They're only allowing you to take 80% of that $200,000, and then you have to carry forward the additional 20. So that is also a really big change for taxpayers. Does anyone have any questions about depreciation or bonus or loss rules? Yeah. What's the difference? Yeah. So they're two totally different things, but I would just go back to the ordering rules. So first you have to take 179. So 179 is limited to your business income. So let's just say you bought a $100,000 asset and your business income is, let's say you only have $50,000 of business income. So you can only take 179 on that $100,000. You can only take $50,000 because you only take it up to your business income. And the remaining $50,000 of the asset, then you could take under bonus depreciation. So unless new guidance comes out or they pass something out else, you have to do the 179 first. So at the end of the day, you're still going to get to write off the whole amount. You just have to do 179 first and then bonus.
The biggest reason they probably do the 179 is because there's recapture. So if you end up selling those assets, whatever was 179, you have to recognize a gain back in ordinary income. And so that's probably the biggest reason to make you do the 179, so at least some of it, if you do sell it at a profit before it would have been depreciated, you have to recapture it.
Right. Yeah, that's the only big difference between the two.
Switch to that, yeah.
Okay.
Okay.
Too much competition.
Okay.
Okay. That answer your question? Okay. Okay.
Oh, okay. So now let's talk about individuals for a little while. Here are the new rate comparisons. And this is for a single filer. And as you can see, there's still 7 categories for the rates. And you can see for most everyone, it is an improvement, except for if you're between 157,000 and 195, actually there's a tax increase for you. Oops. And then here's the same, it's the comparison for married filing joint. And again, it's the, let's see, the 400,000 to 424 is where, again, you have a little higher rate under the new rules, just for that one category. All right, so Holly talked about that for corporations, AMT was repealed, which is great news. Nobody likes paying AMT tax. And it was not repealed for individuals. It's still there, but they did they did increase the limit. And so a lot fewer people will be paying AMT. And I can tell you for our clients this year, we were doing comparisons when we were preparing their 2017 returns, and we were calculating them under the new rules too. And we actually had quite a few clients that were not being required to pay AMT anymore. So that could be a big improvement for you personally. So this is just a summary of a few of the changes I'm going to go through for individuals, and I just wanted to remind most of these individual rules are not permanent part of law. They will be reversing in 2026 unless something happens between now and then. So you guys remember that these tax rules were passed under reconciliation, and so they have budget requirements on that. So in order to do the corporate and the flow through deductions, they had to be able to balance the budget. And so until, you know, hopefully all these tax savings for companies is going to continue to grow our economy, and then they can make these permanent later. But for right now, most of these will be reversed. And we're not going through any of these new estate rules or estate planning rules, but all of those also get reversed in 2026. Okay, so you guys have probably read something about this. So the idea was to try to simplify the 1040 tax return. And so as I'm going to go through, a lot of the individual deductions were have been eliminated, but instead they increased the standard deduction. So the new standard deduction is now $24,000 if you're a married individual, $18,000 for head of household, and $12,000 for all other individuals. So those amounts will be raising every year. They'll be based on inflation. So many of these are deductions that are on your Schedule A, your itemized deductions. So there's been some changes on these recently, and so the deduction was going to be repealed, but it actually kept it. And for the next, through 2018, it'll go back to a limit of 7.5%. So whatever your AGI is, you take 7.5% of that, and you can't take a deduction until your medical expenses reach that. So if 7.5% is $7,500 and you have $7,400 in medical expenses, you can't deduct anything yet because you can only do what gets over that. So after 2018, that percent will go up to 10% is what it was currently. It had been 7.5 and then it was 10. So we always tell people take advantage of any of those employee benefit plans or Section 125 plans, because you're probably not going to get to deduct it on your tax return until we see it maybe later on. If someone is in a nursing facility or something like that, and they're paying out of pocket, then that really kicks in, because if they're paying huge amounts. But for during your working years, it's usually not a real beneficial deduction. But it's still there in case there was a big catastrophe or something and you had a lot of out-of-pocket in 1 year for some reason. There would still be some tax relief for you there. And I'm sure you guys have read about this because this was one of the most written about parts of the new tax rule. So there's now a limit, and you cannot deduct more than $10,000. And that is all of your tax deductions together. So if you pay tax in another state, if you pay property taxes, if you use our sales tax deductions, that's now limited to $10,000. The interesting thing about it, though, it's not lowered for a single payer, or it's just $10,000. So if you're a single payer, a single taxpayer, you get $10,000. If you're a married taxpayer, you get $10,000. So specifically to Washington, so there was a lot of news about this, and there were a lot of states that were very angry about this rule, and like there's very high, states that pay very high property taxes and other taxes, like New York, and us in Washington, we're considered a high tax state, but we're not like the highest. So I looked up before I came today, and the average for the state of Washington, people filing Schedule A's is $7,500. So on average, most of the people, will be covered under the $10,000 limit. But places like New York and Connecticut, their average is like $12,000. So for many of them, they're just not, they're getting hurt. So there's been a lot of, I'm not gonna talk about it too much, but there's been a lot of shenanigans going around about how to get, at the state level, how to get their taxpayers this break. And there's been some talk that maybe you read about where they were going to turn our property tax payments into state contributions. So you could take the deduction on the contribution line, but I think that's gonna be contested, and I don't think that's gonna go too far. So you can watch this space, but right now it's $10,000, and hopefully for most of us, won't impact us too much. All right, so on the home mortgage interest, this is a little bit more complicated. So before, we were able, if we bought a house and we borrowed money up to $1 million, we were able to take a deduction for the interest on that $1 million before it started being limited on our Schedule A. So they reduced that amount from $1 million to $750,000. And so what we're talking about here is new home acquisition. So this is when you get a loan to buy a house, not for any other reason. There is a grandfather clause in there, and so if you just bought a house this year and you took out a loan for $1 million, you will still be able to take, as long as it was a loan used to purchase that house, you'll still be able to take the mortgage interest for up to $1 million. But if you didn't buy the house until January 2nd, you only get to deduct the interest on up to $750,000. So the other big change on that, so for a lot of years, people have been taking home equity loans because you could go pay off your credit cards, or you buy a car, and you get to deduct the interest because it's mortgaged on your house. So that's just completely suspended. So you can only deduct interest now that is for either the purchase of your house, or if you took out an equity loan to do improvements to your house, to improve the value of your house. So you no longer can deduct. And even if you had the loan before, and you were deducting it previously, you can't deduct that anymore. Again, this rule reverses after 2025. So either we'll have something new or it'll go back to the old rules at that time. All right, so charitable gifts is another interesting area. So if any of you work on boards or work with charities, you know that they've been pretty scared about this new rule, because we're thinking a lot fewer people will be filing Schedule A's because the standard deduction will be bigger. And so charities are worried that people won't be donating as much because there won't be as much incentive. They won't be getting tax deductions. So they did raise the ceiling. It used to be for most charitable deductions, you could take up to 50% of your adjusted gross income. That's up to 60% now. Charitable deductions for contributions to colleges for seating rights are eliminated, so you won't be able to consider that charity anymore. Like I said, they think the standard deduction will greatly reduce, so some planning ideas is maybe to bunch up your charitable contributions. So if you have a certain amount you give your church or your favorite charity every year, maybe instead of donating every year, what you do is donate every other year so that you make the bigger donation to get your Schedule A higher than the standard one year, and then take the standard the next year is maybe one way to take advantage of that. Another way is to set up the donor advised fund, which those are fairly easy to do and a good way to tax plan. Casualty and theft losses are pretty much gone unless it's a declared disaster area. So no longer. All right, so on the miscellaneous deduction, the new tax rule repeals pretty much all the miscellaneous deductions. There's a few like bond amortization that still is there, but pretty much all the normal ones that maybe you were taking advantage of are gone. So no, you don't get a deduction for tax prep fees. Bigger ones, the unreimbursed employee business expenses. So if you were writing a lot of those off, you might want to, next time you have the evaluation with your employer, you might want to talk about getting that as part of your compensation packet again, because you can't take the deduction anymore on individual level. So we used to be able to, if we had to hire a lawyer because you know, we were having a dispute over our income, we used to be able to deduct that. You can't deduct that anymore. Again, these sunset in 2025. So here's some good news in all of that. So if you had certain income before, your itemized deductions used to phase out. They got smaller as your income got higher. Well, those limitations are just gone now. So again, when we were running some of these scenarios for our clients this year, we realized even though a lot of these deductions got limited or reduced because there was no overall limitation on the schedule anymore, they actually had a higher deduction. Because so if you're a higher income individual, maybe all these things being gone don't hurt you. They actually help you because the overall reduction's gone. Under the old law, if you paid alimony, the alimony was deductible for the person paying it, and it was included in income for the person receiving it. And so now it's neither deductible or includable. It's just not a taxable event anymore. But that only applies to divorce agreements that were either executed or modified after December 31st, 2018. So that's not in place yet. The child tax credit has been, oh, I just lost battery, sorry. The credit has been doubled, so it used to be $1,000. So it is now a $2,000 credit, and it phases out starting at $400,000 for joint filers. So this is a much better credit, and more of it is refundable. I think it says, yeah, the first $1,400 is refundable, so even if you don't owe tax, you could get that credit. So that's much better. I'm trying to break your stuff. There you go. The moving expense exclusion is repealed. So you don't get that anymore, unless you're a member of the armed service. That's still. Another just general change is considered more of an estate planning change, but I thought I would mention it. So a lot of us get 529 plans for our kids to put them through college. So it's kind of like a Roth IRA. When you get a 529 plan, you don't get a deduction when you put it in. But all the earnings on it is tax-free. And then when the kids go to college, you get to start taking it out. You don't have to pay tax. So they did expand that. Before that was only for college. And now they've expanded it that you can actually use your 529 plan dollars for K through 12 for private schools, for your elementary and high school and middle school kids. Another thing to note, so a lot of us when we're doing our tax planning, so as we're getting closer to retirement, we're wanting to get maybe some of our IRAs into Roths because we're trying to plan out how much we have to take out in distributions. And if we're in our high working years, we probably don't qualify to make contributions into Roths because our income is too high. So what they've done in the last few years is they allow you to do conversions, and what people would do is they would do conversions in the beginning of the year, and then later on in the year, if they ended up having a very high income year, because you have to pay tax on it when you do that conversion, they would go, oh wait, I made too much money this year, I don't want to make that IRA conversion anymore, that Roth IRA conversion. And so under the old rules, as long as you put it back before you filed your tax return that year, that was all right, you could do that. So you're not allowed to do that anymore. So if you have Roth conversions as part of your retirement plan, you're going to have to do that planning at the end of the year because there's no reversing it. So if you do it at the beginning of the year thinking like maybe next, if I don't like it at the end of the year, you'll just be stuck paying the higher tax on that. So I guess the message here is be sure you're committed to that before you do it because there's no more reversing it. The other thing I didn't mention, but I think it's been pretty widely, is so there's not exemptions for your dependents anymore. So that was also excluded. And so that's what this higher standard deduction. So if you had 5 kids and you and your husband and you were deducting, you had a pretty big exemption, that's just gone. So that's just not part of the tax return anymore. Okay, so then we're going to quickly go over a few more possible tax savings you can do under these new rules, and then we'll take questions.
Okay, so tax savings opportunities for businesses. So this IC disc, this is just for companies that do exports. So if you are exporting anything and you don't know about IC discs, this is a good one to get educated on, get familiar with. But this is for if you're exporting indirectly or directly. So as long if you have products going out of the United States, but you're not shipping directly, so maybe you're shipping them to somewhere on the East Coast, but then they're shipping them out of the country, you could qualify. Those are still exports, they're just indirect exports. You could qualify for this IC disc. And so what an IC disc is, it's basically just a paper company, it's a corporation. But under the tax rules, IC discs are not subject to federal taxes. So you do not pay federal taxes on the revenues. And so how that works is the operating company pays a commission over to the IC disc company. So the operating company gets a deduction on their side, and then the IC disc picks up commission income. But they do not pay tax on the commission income. But what they do pay is an interest on the income that's accumulating at a really low rate. Right now, I think it's like only a fraction of a percent. And then the only time that money does get taxed is when the owner pulls it out. And so that is still considered dividends. But again, it'd be at the lower dividend rate. So depending on the earned income rate, it's going to be taxed on possibly 0, 15, or 20%. So this is a good way of shifting income, lowering your tax burden if you do exports. And then another thing that you can do with IC disc is it's a strategy for your executive owners to getting them to pay lower tax rate, because the IC disc, the owners do not have to be the same owners as the corporation. And you can also do this if you're a S corporation. So the IC disc can be different owners. So it's a way of shifting income for executive owners. And this is also used, can be used in estate planning as well, because if you have a large estate and over the taxable estate, you could have your kids as part owner of the IC disc, or any commissions you put over the IC disc actually gets, because it's a corporation, it gets it out of your estate. So if you're in an S corp, you have taxable estate, you want to get some money out of there, you could do it by setting up an IC disc. But that wouldn't be the main point of doing this. And the main point is, really like shifting your income tax burden and paying lower tax. So I just wanted to mention that because this is becoming more popular, and I just think people forget about it. There are other rules and guidelines. It's more complicated than this, but I wanted to mention that. If anybody is doing exports, it might be something you want to look into doing. Okay, so this is new. So this is the new paid and family leave credit. So, and this is good for only 2 years. So this is good for 2018 and 2019. And so the credit amount is 12.5% of wages, plus an additional 0.25% for each percentage point in excess of 50% of their salary. But they do cap the credit at 25% of their salary. So for any companies that are offering this to employees, they're now giving you an incentive for that as a credit. It's also be a new credit, but again, it's only good for the next 2 years unless they extend it. The work opportunity tax credit. So this is not a new credit, but this is a credit that still got extended. This credit, you do have to apply. The only hard part about this is you do have to apply for this credit, and you have to apply at the time you're hiring the employee. So if you hire an employee and then months later down the road go, oh wait, well we could have gotten the work opportunity tax credit as an employee, well it's too late. So you want to make sure you have this, know about this ahead of time. So this is a credit if you hire long-term temporary assistance for needy families. So it's for that targeted group that gets the highest credits. So the first year you could get a credit of up to 40% of wages if they work at least 400 hours. And then the second year you get a credit up to 50% of wages if they work at least 400 hours. And then you can also get this credit, it's a lesser credit, but the other targeted groups are veterans, food stamp recipients, supplemental security income recipients, summer youth employees that are living empowerment zones, ex-felons, other people living in empowerment zones or renewal communities, and vocational rehabilitation referrals. So that's the bigger targeted group, yeah. That's a good question. It might, she was wondering if the opportunity zone qualifies as the empowerment zone or renewal communities.
You just have to look up.
I would, yeah, I don't know. It sounds like it probably would be, but I'd have to look into the zones to find out for sure. So those are all, so you only get a first year credit on those workers, and it's up to 25% wages paid if they work 120 hours or 40% up to 400 hours. So you still get credits with those targeted groups. The only thing, like, I guess, feedback too I've gotten from clients is when you're interviewing somebody, like how do you ask them, or can you even ask them, like if they fall into any of those categories? And I'm not HR and I'm not an attorney, so I don't know that answer or how you would do that, but I know companies are taking these credits, so I think if there's anything that is holding you back or you can't take it would be because of that issue.
I think you have to volunteer the information, so you can ask it, but after the hiring, you can't hire them because of that.
Right.
Yeah, but you can't require them to tell you if they're one of those groups.
Right. So, but this credit has been around for many years and it's still there. And I know a lot of businesses do hire these employees and aren't taking the credit. So I just wanted to make sure I went over that again. Okay, so the next big tax incentive that you could do is a cost segregation study. If you own a building, so this is for building owners, and what it is doing really is it's accelerating your tax depreciation deductions. So the IRS says if you don't get a cost segregation study, then everything, like if you buy a building, everything inside that building, you don't get to piece it out. Just if you buy a building and land and it's $2 million, you're carving out the land, and just say 1.8, you're taking over 39 years. Well, if you get a cost segregation study done, there are some requirements too, like you do have to have an engineer involved, and there's some other requirements, but what the IRS allows you to do is they let you carve out tangible items from the building. So the study comes in and they do things like each single one of these lights get carved out, and you can depreciate them over maybe 7 years versus 39. The molding, if the blinds, pretty much it take the signs, like everything you see in the room can get carved out and get depreciated over lesser year, but you have to do it through a cost segregation study. And the other thing that the IRS lets you do is, so this is a one-time deal. So if you decide, oh, I want to do a cost segregation study, maybe you want to wait until it's a year you're going to be paying a lot of tax, because they let you catch up your depreciation the year you do the study. So let's just say your building's been in service for 7 years already, and you're just learning about this idea, and you're like, yeah, I want to have a cost segregation study done. And you do the study, and it comes back, and now you're getting to take $300,000 of additional depreciation because you weren't depreciating all those items over 5 years or 7 years for the first 7 years. Now you get to catch up all that depreciation that 1 year. And the IRS allows you to do that. So it's a good tax saving strategy for, one, you want to lower your taxes, or maybe you want to wait till you're going to be paying high taxes, and so you want to wait till that year to do that cost segregation study. Yes?
Holly, what about building expansions?
Yes, same thing. Yep, so same thing. So we have some clients who are doing building expansions or really big remodels, right, of buildings. And so we wait until it's totally done and occupied, letter of occupancy. And then we'll do a cost segregation study, and it's the same thing, but then you'd come in and you'd do your whole building. Again, because if you don't have that study, what's going to happen is all your costs you put into that building expansion are going to fall under 39 years, unless you get this done. So IRS says if you want to do that, you have to get a cost segregation study done.
So if the original building is older than 8 years,
That's like the
big addition to it?
Yeah, so we say about 8 years would be your most beneficial period, right? Because the more depreciation you've already taken, you have a smaller basis. So that would be like the best year to do it in. But if you're doing, so it just depends on what you're doing or how much depreciation you've already taken on the building and what the basis of the building is too. So something really small, if the basis is really, really small, you're not going to have that much even to carve out to take the accelerated depreciation on.
We have good estimation tools, so we just run the estimation tools to see what the potential benefit might be for people to make the decision on whether they want to do it.
Yeah. Yeah, so it's easy to do. So I've done a lot of these, and I have clients, and I just get some information for them if they want to get an estimate of what their tax savings would be to doing a cost segregation study. So that's still around. The other benefit of doing cost segregation study is partial dispositions. So like right now, how do you carve out, let's say you did buy a $2 million building and you get all new windows. Well, how do you carve out or assign a cost to those windows? Basically, you're stuck depreciating that over 39 years. You never get to carve that loss out or recognize the loss. And so by doing the cost segregation study, you're going to have a big list of every single thing. And this is interior and exterior. So it even goes for your parking lot paving, the paving lines, if you have loading docks, trees, shrubbery. I mean, it's everything. So it makes it a lot easier when it does come time where you're updating one thing or a couple of things in your building or restriping the parking lot or anything like that. So that's another advantage for doing one of these cost segregation studies. And then I guess the other thing is too, if you are doing like kind of exchanges with real property, or if you are doing like investing on the side, or an investor where you, we have real estate investors who will buy properties, do these cost segregations, get all this depreciation, but then they're going and buying a new property and doing a 1031 like-kind exchange. And so they're still not recognizing the gain on that building. It just forever gets suspended until I guess they're done with their last building, or, you know, it goes to somebody else. So it's a good strategy for a lot of real estate investors as well. And then this last one, so this is one of my specialty areas that I do at JSP. And so this credit, this is the R&D, the Research and Development credit. And this is really for any business who's innovating, who's trying to make their processes better, trying to make their quality of products better, doing anything with green initiatives, waste reduction. This applies to manufacturers, job shops, sheet metal companies, wineries, breweries, architect firms, software development companies. So this credit was put in place really to protect US jobs. So it's heavily based on labor and wages. The biggest three costs are wages, supplies, and subcontractor costs that go into this credit. And it's, this credit was put in place to protect US jobs and to keep R&D moving along, so like we're not going and hiring someone offshores to do our jobs here. So protecting jobs and keeping our business profitable. So if you are doing any kind of innovation, if you're doing anything with mechanics and materials, you don't have to be doing anything new to the world. It just has to be new to your company. The kinds of companies that get the biggest credits are architect firms, or companies that do specialized types of jobs where they're not just doing reproduction of the same thing over and over again. So architects get the biggest credits usually. There are some manufacturers who get very large credits as well, because they do, every job is like a one-off job where they're doing a specialty, something different. Yes?
Is that a form, or does that show up somewhere else in the return?
Yep, this is a credit, so it's a dollar-for-dollar credit, and there is a separate form that gets filled out. I think it's 6765. And so, yeah, so we fill out that, we calculate the credit, we fill out the form, and then you get a dollar-for-dollar reduction of your tax. It's a non-refundable credit, so you can carry that credit forward. And if you haven't been taking this credit, you've been overpaying your taxes. But what we can do is go back 3 years and get your money back for the past 3 years you should have been taking this credit. Yes? Yep, improvements to processes, procedures, efficiencies. We have CNC machine coding, buying new equipment, figuring out where you want to put on the floor, all that time to get it up and running. All of that stuff is considered R&D.
It's unfortunate they used R&D as the term, really, because when people think about R&D, they think about blue and white coats, new patents, and that's how it traditionally started. But it has been over 10 years now. They really revamped the whole thing. A lot of it happened after 9/11, and a lot of it was to, we're really behind the rest of the world in giving R&D tax credits to our manufacturers, and so this came, and it works for small businesses now, and we have a very affordable, bulletproof way of helping people take these credits for, like, you don't have to be Boeing anymore to take them. And they recently made AMT less of a problem. So it used to be that S corps couldn't really, like, they could qualify for the credits, but they couldn't get the credits because the AMT always wiped it out. And they was that last year, Holly, that.
Yeah, so we were doing a lot of these estimates for companies, and the company may have generated like $100,000 R&D tax credit, but what happened was, because there's a flow through, then it flows through to the individual, and at the individual level, all business credits have an AMT cap. So some of these businesses, even though the business generated credit, weren't able to actually take the credit because of that AMT cap. And so what the IRS did last year is they dropped that AMT cap for small businesses. But keep in mind their definition of small business for this credit is $50 million of average gross receipts for the prior 3 years. So that's their definition of small business for the AMT threshold. So if you're a business under $50 million and you're a flow-through, you're not gonna have to worry about the AMT cap anymore. So if your business, generates a $100,000 tax credit, you're gonna be able, as a business owner, to take that full $100,000 now. So that's huge.
Right, and the other huge thing that happened recently, so if you're a startup company, it's possible you can use these R&D tax credits to reduce your payroll tax.
Yeah,
So that's new in the last couple years.
right,
That's a big topic, and we'd be
Yeah.
happy to
Yeah.
talk to you guys about it.
yeah,
Really, you should read about it, or maybe do some Googling if you're not aware of the benefits of that, because it is really underutilized, but there's a lot out there written about it now, as people are starting to realize there's a lot of incentives to take it.
yeah.
So I can see how this would be really well utilized in Pierce County. Is there a link, is it the IRS website, or is there a link to a specific program that folks can also learn more about?
Well, the program that we use an engineer from Denver,
Okay.
and his name is Titan Armor is there. That's who we work with to do the data collection, and we do the tax work on it, but they help with the data collection.
If we have a form number, there should be instructions.
Yeah, I would just there's a lot of, I would go to your industry magazines and things and see what people are writing about that, to see, more than reading the instructions. It's very heavy, but, well,
Yeah. Yeah, I mean, it's the most underutilized credit. And so there's so many businesses here in Pierce County that aren't taking the credit because, well, there's probably 3 biggest reasons. Are 1, they don't know about the credit. 2, they don't understand the definition, the IRS's definition of R&D. So they don't understand that they could be taking the credit. 3, their CPA's not educated on the credit, or they think of it as a risk of taking the credit, so they don't want to do it for their client. Or 4, they have explored the R&D credit before with an outside company, and the cost was basically as much as their credit was. So I'd say those are the 4 biggest reasons of why businesses aren't taking it. But like Anita says, we can do a very affordable R&D study, and we do free estimates for people who want to just get an estimate on see what their R&D credit would be, and then I always follow up and I give them a cost-benefit analysis to make sure the cost benefits there, because you're not going to take the credit, right, unless you have a good cost-benefit analysis done.
it's probably about an hour and a half commitment because it's kind of an education when you do that with our engineer partner about interpreting it for your business and how that works.
Yeah.
I had a question on employee benefits.
Okay.
I went to earlier. So it's no longer deductible for transportation, so if you want bus passes or whatever it is. Does that have to show up then if an employer still wants to do that? Is that now income to the employee?
Yes.
It shows up on the compensation on the billing?
Yes. Yep.
If they don't put it there,
Yep.
then they can't deduct it. So why would you pay it if you weren't going to deduct it?
Because you want to do the right thing and have people
Right.
less, have the workers
Right.
less.
You could do
There
that.
might be some
Right.
companies that do it.
Yeah, you could do that.
But that has to show up as income.
Yep, to deduct it. Yep, it has to show up as income if you want to deduct it. Yep. Yes.
On the tax savings opportunities,
What would be a good spot for that?
We'll do
We
free
can
evaluations
email.
for those also.
Yeah, we can always email you. We have information on that we can email you that's not as technical, I would say, because if you go online and try to start reading some of that stuff, it could get a little bit too technical.
I see this are it's very old tax strategy, but what changed about it in recent years is they set up safe harbor calculations. And so before, again, it was kind of like the R&D or these cost tags, they were too expensive for small companies to consider them. But now, and they were a little bit riskier. But now, there's much more with all the technology. We're able to run these complicated calculations using, computers. Doesn't cost as much to come up with them, and most importantly, they're safe harbors. Where the IRS says, if you use this method, and then you're safe. We won't, like they will accept that calculation.
Yes. Okay.
For the work opportunity tax, oh, thank you. For the work opportunity tax credit, you said we have to apply for this credit when we're hiring. So is it actually, it has to be applied for by the day we say we would like you to be an employee, or you say when we're actually looking at someone as a candidate, we have to apply?
I think I don't know like the exact day,
Okay.
the days to do it. But you do, I just know you can't wait like months after and then
Okay.
like apply. So, I mean, they do, there's stuff all over the website too. There's actually a website, it might be WOTC.com. But there's a website just all about this work opportunity tax credit. It tells you like how to apply for it, it has the dates, it has way more information on there. So I would suggest going there and looking. But I mean, they're gonna have some lead time, and then they'll tell you like how many days. And I don't know off the top of my head how many days, but I do know you can't wait like half a year,
Right.
and then go back and apply. They won't let you do something like that.
Right, okay. And then my other question was just regarding the entertainment expenses. So give me an example of, again, I know a lot of us as businesses will get Rainier tickets and then, hand them out or whatever. Will you go through that just real quick?
So tickets now are non-deductible because they're entertainment.
Okay.
So sporting tickets, taking someone to golf, those are like the two biggest examples where that's non-deductible. And so I sort of ran through sort of fast, but that one example talked about going to a sporting event and buying snacks or drinks there, and how they're saying, you really think of that as food, but in this situation, they're attaching it to the entertainment activity
Right,
and saying that that's even non-deductible too.
right, okay.
But, there's still more rulings to come out. Like, everything's not out yet. There's still more guidance that hasn't come out with every single situation. So there's, they can always change that.
I've had a lot of clients say, well, that's not entertainment, Anita, that's marketing.
Yeah.
So, like, I think there will be more.
Right, there has to be more guidance on, because there's just, again, it's not like black and white. There's still a lot of gray lines. So we just have to wait till like guidance is out, because everyone's asking the same type of questions, and like Nina's saying, we think like now we're gonna see a shift where we're gonna see all these costs go from me as an entertainment, and now we're gonna see the marketing expenses go way up, right? Because now people are gonna start booking over to marketing. And, so it's just one of those areas that is gonna have to have more guidance out as the years
All the
come up.
strategies haven't come in, but I did read that on the parking, if the parking is a part of your lease, like if you just, in leasing your building, you also get 7 parking places, then that's just part of your lease expense, and like that's still, even if your employees use it, that's fine. But if you're paying some extra, so if you have your lease over here and then on separate from your lease, you rent 7 spots for your employees, well then you can't deduct that anymore unless you put the cost of those onto your employees' W-2s. So there is going to be some planning that, sometimes you can't negotiate that because sometimes it's not the same owner or something, but like you can negotiate stuff like that. There's ways to still do it.
Okay, thank you.
You're welcome. Anybody else? Yes.
On the passenger cars, the 18,000 cap, is that per passenger car, or is that for all passenger cars for the company?
That's
both
per
buys?
car.
That's
Per car that you purchase.
And that's 18,000. So if you buy a $30,000 car, 18,000 the first year, and then,
Yep, and then the next year goes to
Remainder-
that second year cap. I can't remember off the top of my head what it
Okay.
is. So it just goes down the line.
it goes down the line.
Yep,
And-
per car.
And leases aren't subject to this. This is just if you purchase a car.
Yeah.
Okay.
So leases are sort of definitely have different rules and inclusion amounts that you have to calculate for tax return. Yep. Any other questions? Okay, yeah, so I just want to mention too, I don't know if everyone got to pick up, but we have little postcards with about 3 questions on there. I'd appreciate if
I'll
you
get 'em.
guys could fill those out. One of those is regarding the R&D credit, if you were interested in learning more about that, or if you just want a free estimate, we will contact you. And then our business cards are out there as well, so if you have any questions and want to learn more about tax planning or any of these changes, feel free to contact Nita or myself. Thank you.
Thank you very much. Okay, that will end our session. And again, if you don't have one of these cards, I have them. If you can fill them out, that would be wonderful. And thank you very much, and we'll see you the next time. Have a great day.